Hi everyone, it's your daily 10-minute business and finance news wrap for this Friday, the 29th of April 2022. Later, electricity prices are on the rise, but first to the Reserve Bank, which is tipped to lift official interest rates for the first time in 11 and a half years next week. And that is because inflation is soaring. Today, we even saw another impact of that, the producer prices or final demand, that's basically business inflation, surging to 4.9% annually. That is a 13.5-year high. The main number we got this week was the CPI, the Consumer Price Index, up 5.1%. That's basically headline inflation, and that's the highest since the GST was introduced. But do you actually know what inflation is and its relationship with interest rates? Well, for more on that, I spoke earlier with Angela Jackson from Impact Economics.
Look, what the Australian Bureau of Statistics does is it takes what we call the basic basket of goods that the average Australian household spends their income on any given month. And that comes from their own survey of household expenditure. It then weights all the prices across the economy to come up with one figure that tells us about the general rate of price increases across the economy. So inflation tells us how that general basket of goods is going up over time.
Okay, so the Reserve Bank wants there to be a little bit of inflation. It wants the underlying rate, which is something a little bit different because it strips out one-off variables, but it still wants that underlying rate of inflation between 2 and 3%. So inflation can be good?
Well, that's right. So we want a little bit of inflation in the economy. The reason for that is we want people to be incentivized to spend today rather than to save tomorrow. So what the Reserve Bank and what a lot of commentators and economic researchers have done is found that that inflation rate between 2 and 3% is a sweet spot, if you like. It's enough to encourage us as consumers to spend today rather than save for the future, but it's not so much that it causes instability and distorts some of that decision making across the economy. So it's what every single central bank pretty much around the globe is looking for. It's that sweet spot of price rises that encourage consumers to spend today, but isn't so high that causes that instability and distortion in those decision making across the economy.
Okay, so the latest figure that we saw, the headline rate of 5.1% annually, just how bad is it, and what is the impact or the implication for the economy?
So I guess what that figure represents is, it's outside that 2 to 3%. So for households trying to make decisions and for businesses trying to make decisions, it starts creating a little bit of uncertainty about, well, how much are prices actually going to go up over the next 12 months? Because what I had expected was, like the Reserve Bank told me, was that they were going to go up by 2 and 3%. Now they've gone up by 5% on average. That creates uncertainty in the economy. So the reason that we don't like it, one is obviously it's a cost of living pressure. It means, the real purchasing power of households is going down, and for some low-income households that has a real impact. But from that sort of macroeconomic perspective, it's putting a lot of risk into the economy. So what we want to see is really the Reserve Bank move to say, look, we are still committed to that 2 to 3%. So you can relax. You don't need to start acting as if there is this price instability, because once that occurs, we'll see obviously prices continue to rise, but also we'll see some decision making across the economy not being as optimal as it would have been otherwise.
So one way inflation can be controlled is by lifting interest rates. How does that work?
Yeah, so obviously the interest rate is really important in terms of the macroeconomic economy. So when the Reserve Bank increases interest rates, what we will see is demand generally across the economy reduce. Now that's through a couple of mechanisms. One is in terms of if businesses are looking to invest or to borrow, the threshold for doing that suddenly is higher. So maybe you reduce some of that spending. On the other side, you've obviously got mortgage holders and people who have already borrowed money. It reduces the amount of money and disposable income they have because they're paying higher interest costs. So interest rates are important in that sense. It sets a risk-free, if you like, cost of money across the economy. But for the Reserve Bank at the moment, what they'll be really looking to do is it's a signal, I think, more than anything, to the market and to households that they are going to act and that they are going to maintain that price stability of, keeping inflation, at least aiming to keep inflation between that 2 and 3%.
Angela Jackson there from Impact Economics. Now to electricity prices, where wholesale power prices rose 141% over the March quarter. That's according to the Australian Energy Market Operator. What does this mean for your power bill? For more, I spoke earlier with Guy Chandler from PwC.
So, Ricardo, the first thing to remember is that the wholesale electricity price, particularly the spot price, which is what you just quoted, only makes up a component of your consumer and small business electricity bills. The other components are your network charges, effectively for transporting electricity to your property, and the retail charges, which you pay to the retailer for managing the fluctuations in wholesale electricity prices. So having said that, it isn't good news for consumers and for small businesses. Prices are going up, and we will see that reflected in household bills. However, it's also important to recognise that we are coming through from a period of 2 years of particularly low prices. Prices were significantly higher than this in Q1 2019. And since then, we've seen lower demand, primarily as a result of COVID, and some cheaper input prices that have meant that power prices have been particularly low for the last 2 years.
Do you have a rough estimate as to how much prices could rise as a result of this increase in wholesale prices?
It's difficult to forecast. That's up to the retailers to work out exactly how they will start to recoup some of those costs. And we also won't have a clear picture until we see the retail market offer being defined later in May. That effectively acts as a ceiling and gives consumers an opportunity to be able to compare the various power plans that they're on with that retail market offer.
Okay. Why are prices rising so much lately?
So there's a number of different things. The first is that we have seen a significant increase in input costs, particularly for coal and gas. And that's obviously driven by international market dynamics. We've also seen a significant increase in demand in a number of different jurisdictions. Queensland particularly saw its highest ever demand on March 8th of this year. And all of those factors come together to basically increase wholesale spot prices.
And finally, do you think this will add to the push to a move towards more renewable sources of power?
So the move towards renewables in the Australian energy system is pretty much unstoppable. We are seeing that happen, and we're seeing it happen quickly. Wholesale prices are not really the determinant of how quickly we move. There's a number of other factors, including energy security, energy system stability, as well as reliability. And really, it's the investments that we need to make to ensure that the overall system stays reliable and stable. And that is the driver of time. Wholesale prices obviously attract new investment, and that's obviously helpful, but it's not the key determinant of timing.
Guy Chandler there from PwC. Finally, to the Australian share market, which rose today by 1.1% to 207,435. For more, I spoke earlier with Matthew Sherwood from Perpetual. Matt, the market's up today. Why?
Well, there's two reasons. The market put on a solid gain. The first one was because the market had dropped 3% in the prior three sessions. And secondly, there was a positive lead from Wall Street overnight, who had better than feared earnings results in some of the tech sector. But that optimism was tempered after the market closed in the US with some disappointing comments coming out of both Amazon and Apple. So, I tend to suspect the US market may give back some of those gains tonight.
On more thematic news, though, the doubling in government bond yields over the past 6 months, are you surprised that global share markets have taken that so well?
Yeah, that's a good question because, bond yields have increased from about 1.5 to just under 3. And normally that would lead to quite a bit of volatility in markets. And the global share market is down by about 12% from its peak last November. But I would have thought there would have been a larger decline in equity prices. But investors seem to be optimistic about the earnings outlook despite all of these inflation cost pressures. So, it's hanging in there for the moment, but one does suspect the balance of risks is to the downside.
All eyes on the Reserve Bank of Australia next week, but we've also got a rates decision in the US too. Just how aggressive do you think the market is expecting rate rises to be?
Yeah, it's a big week for central bank meetings. So, probably the biggest rise expected by the markets is in the US by the Federal Reserve. So markets are expecting a 0.5% increase in the Fed funds rate to 1%. In Australia, the people who I respect in markets say the RBA will probably be tiptoeing and going up by 15 basis points to 0.25%. And I don't think there's going to be any move from the Bank of England. But, these are going to be the key things that markets look at through this week, particularly the Fed Reserve. And they're going up the most there because they've got the highest inflation and the tightest labour market and the highest wages growth. So I think those expectations are well founded.
Do you think, though, with talk about how aggressive some central banks may be in lifting interest rates, given that a lot of these rate rises are now coming earlier than expected because of the onset of inflation, is there a threat, though, that by lifting interest rates, it could derail the global economic recovery coming out of the pandemic? Because we just saw the US record negative growth in the last quarter.
Well, with respect to interest rates and its impact on the economy, there are two key variables here. First of all, how high do rates go? And secondly, how quickly does it get to that destination? And the Fed is having to do the largest and fastest tightening cycle in 28 years. So, it's certainly uncharted territories for all the members of the FOMC. As they're tightening quickly and tightening by a lot, it does bring downside risk to growth. But the negative result we got for the March quarter US GDP wasn't reflecting the fact the US economy was floundering. We had very good consumer spending growth. We had very good business investment growth. So the composition was good. What led to the negative result was a boom in imports and also the dynamics of the inventory cycle. So to me, the result was negative, but the composition was really, really constructive.
At the end of the day, though, we are in a rising interest rate environment, a higher inflationary environment. What does that all mean for investments?
Yeah, well, given the inflation rise we are seeing is on the cost side, so it's, business input costs such as commodities, such as labour, that will weigh on earnings growth moving forward. And at the same time, of course, discount rates go up as bond yields rise. So that's kind of like a double hit for global share markets. And we still have the uncertainty of China with its zero COVID policy, the war in Ukraine. So there's a lot of headwinds at the moment for financial markets, and I tend to think the key is playing a good portfolio defence after 2 years of pretty good gains.
Matt Sherwood there from Perpetual. This SBS on the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.